Welcome to our lecture on financial management. Today we will talk about financial ratio analysis. Let's begin. Financial ratio analysis evaluates a company's financial performance by examining relationships among financial statement items. These ratios transform raw data into comparable measures for assessing profitability, liquidity, efficiency, leverage, and market valuation. Purposes include evaluating financial health, comparing companies, identifying strengths and weaknesses, and supporting investment and managerial decisions. Financial ratios are grouped into 5 categories: liquidity, efficiency, leverage, profitability, and market value. Liquidity ratios measure a company's ability to meet short-term obligations, showing financial flexibility. Two of the most important liquidity ratios are the current ratio and the quick ratio. Current ratio is calculated as current assets divided by current liabilities. For example, for a company that has $600,000 in current assets and $300,000 in current liabilities, the current ratio would be equal to 2. A ratio above 1.0 indicates short-term assets exceed liabilities, signaling good liquidity. Quick ratio is calculated as the difference between the current assets and the inventory divided by the current liabilities. For example, for a company that has $500,000 as the difference between the current assets and the inventory and $300,000 in current liabilities, would have a quick ratio of 1.67. This excludes inventory, which may not convert easily to cash for a conservative liquidity view. Efficiency ratios assess how well a company uses assets to generate sales. Some of the most important efficiency ratios include inventory turnover, accounts receivable turnover, and total assets turnover. Inventory turnover is calculated as cost of goods sold divided by the average inventory. For example, for a company that has $400,000 in cost of goods sold and $100,000 in average inventory, the inventory turnover would be equal to 4. Accounts receivable turnover is calculated as net credit sales divided by the average accounts receivable. For example, for a company that has $500,000 in net credit sales and $50,000 in average account receivable, the accounts receivable turnover would be equal to 10. Total asset turnover is calculated as the net sales divided by the average total assets. For example, for a company that has $1 million in net sales and $500,000 in average total assets, the total asset turnover would be equal to 2. Leverage ratios evaluate long-term stability and debt management. Some of the important leverage ratios include debt-to-equity ratio, debt ratio, and times interest earned ratio. Debt-to-equity ratio is calculated as total liabilities divided by the total equity. For example, for a company that has $800,000 in total liabilities and $1.2 million in total equity, the debt-to-equity ratio would be 0.67. Debt ratio is calculated as total liabilities divided by the total assets. For example, for a company that has $800,000 in total liabilities and $2 million in total assets, the debt ratio would be 40%. Times interest earned ratio is calculated as earnings before interest and taxes is divided by the interest expense. For example, for a company that has $200,000 in earnings before interest and taxes and $40,000 in interest expense, the times interest earned ratio would be 5, showing ability to cover the interest expense. Profitability ratios measure how effectively a company generates profits. Some of the important profitability ratios include gross profit margin, operating profit margin, net profit margin, return on assets, and return on equity. Gross profit margin is calculated as the gross profit is divided by the net sales. For example, for a company that has $400,000 in gross profit and $1 million in net sales, the gross profit margin would be 40%. Operating profit margin is calculated as the operating income divided by the revenue. For example, for a company that has $200,000 in operating income and $1 million in revenue would have operating profit margin of 20%. Net profit margin is calculated as the net income divided by the net sales. For example, for a company that has $100,000 in net income and $1 million in net sales, the net profit margin would be 10%. Return on assets is calculated as the net income divided by the average total assets. For example, for a company that has net income of $100,000 and average total assets of $1 million, the return on assets would be 10%. Return on equity is calculated as the net income divided by the shareholders' equity. For example, for a company that has net income of $100,000 and shareholders' equity of $500,000, the return on equity would be 20%. Market value ratios relate stock price to earnings and book values for investor evaluation. Some of the important market value ratios include price to earnings ratio, earnings yield, and price to book ratio. Price to earnings ratio is calculated as the market price per share divided by the earnings per share. For example, for a company that has a market price per share of $50 and earnings per share of $5 would have a price to earnings ratio of 10. Earnings yield is calculated as the earnings per share divided by the market price per share. Price to book ratio is calculated as the market price per share divided by the book value per share. For example, for a company that has a market price per share of $50 and book value per share of $25 would have a price to book ratio of 2. Interpret ratios via industry benchmarks, time trends, and cross-firm comparisons. For example, Company A having a price to earnings ratio of 12 versus industry price to earnings ratio of 18 would suggest undervaluation. Ratios rely on historical data, ignore qualitative factors, require industry comparisons. Financial ratio analysis is essential for financial management and investment decisions. Understanding these ratios provides insights into company financial health and prospects. This knowledge supports informed finance decisions in investment, lending, and management. Thank you for watching our lecture on financial management, focusing on financial ratio analysis. See you at the next lecture.